All right, so you're thinking about buying a home and you're wondering, can I actually afford those monthly payments? Well, that's really the million-dollar question, right? We're going to break it down in this video so it's easy to understand. Okay, first things first, what's in a mortgage payment? Unlike your rent, which is usually a flat amount every month, a mortgage is made up of a few different things. Here's what you're looking at. Biggest part of your mortgage payment is your principal and interest. This is the heart of your payment, the loan you're paying back plus the interest. Second part, homeowners insurance. You need insurance to protect your home, and this cost is added into your mortgage. You also have property taxes, and keep in mind that property taxes can vary based on where you live, and yes, they can go up over time. The next part of your mortgage payment is mortgage insurance. Now, I just did a video on this. It'll be linked in the bio. But in general, if you put less than 20% down, you may need to pay mortgage insurance. All right, finally, there's this thing called HOA fees. HOA stands for Homeowners Association fees. These won't technically be a part of your actual mortgage payment. You won't see them on the statement, but you should still consider them because you're going to be billed by the HOA monthly, semi-annually, quarterly. So consider that as part of your budget. I consider it as part of your payment because you're going to have to pay it as long as you own the house. Let's talk about a few important questions that you should be asking. Number one, can taxes go up on me? Yes, they can. Property taxes are sneaky like that. They will go up most likely, so be prepared for that. Number two, can my homeowner's insurance go up? And the answer is absolutely, depending on your home's needs. So you're going to want to develop a relationship with a trusted homeowner's agent, a homeowner's insurance agent, I should say, and make sure that you are aware of any changes on the horizon. Now, here's the biggie. Can my mortgage rate go up? And the answer is if your mortgage is what is called an ARM, an adjustable rate mortgage, or if it's a temporary rate buy down, your rate can go up. And a temporary rate buy down is a relatively newer product. So make sure you talk to your lender about when the rate change is going to happen. So ARM and a temporary rate buy down, your rate can change. That's going to change your payment. You got to be ready for that. Which brings us to the next question. How much can you afford? There's a couple ways to look at this. The first way would be, what do the loan guidelines say you can afford? Now, the government thinks you can handle up to 45% of your income going towards all your debts, mortgage, credit cards, student loans, all that. So as an example, if you made $9,000 a month before taxes, you could potentially afford up to $4,000 in total debt payments according to conventional guidelines. Okay, now, if we go with an FHA loan, which is a government-backed option, it's probably the top two most popular, conventional and FHA. Now, with FHA, they'll actually stretch your budget a little bit more. They say that you can typically go up to 56% of your income. So on that same exact example, you earn $9,000 a month. With a conventional loan, remember, they're saying $4,000 in total. With an FHA loan, you could afford up to $5,000 in debt. That's $1,000 difference. Now, before we go any further, if you are a lender, if you're in the industry, sit tight. I know that these numbers vary a little bit and there's all kinds of exceptions. I'm just giving the general guidelines here. Just want you to understand the difference in what the government in FHA versus conventional think you can afford. Don't just use the ratios. Loan guidelines are simply that. They are guides. They are guidelines. They don't take everything into account. For example, with homeownership, you're going to have costs like maintenance, you're going to have repairs, you're going to have months where utility bills come in a little bit higher, and those surprise expenses can pop up when you least expect them. So you have to be ready for that. The other big thing here that we always talk to our borrowers about is how stable is your income? Now, if you're a commission-based and you're working in an industry that is shrinking, or you're just a little unsure about your future, you need to be able to account for loss of income or loss of job. Can you find a backup job if you lose your job? I guess the real answer to can I afford it? Well, my suggestion to you is to take a look back, or take a step back and look at your entire financial situation, not just the loan rules. Think about all the extra costs of owning a home and ask yourself, can I handle a little unexpected expense or a month of income that is lost or lowered? If you're still confused, don't worry, I got you. Let's talk about your options and figure out what you can afford, not just what the guideline says. If you are dealing with a mortgage right now, or if you have a question about rate or anything at all, we are always here to help. Have a wonderful day.